You leaving money on the table again? Mister had a pullback today. Well, I'm thinking about the puts. I really like the idea. I like the idea. $57.60s. Rather, $2. I'll be right back.
totals. And I think that's the problem. And so it hasn't yet hit balance sheets and the possible losses. And I agree with my co-panelists that, of course, if this affects the balance sheets meaningfully, the prices will go up. The problem is that with inflation, insurance has already skyrocketed pretty much across the board. And it's just going to make it so unaffordable. And particularly in Florida, where I am, where I was hit by both hurricanes in Tampa, you know, it's going to be hard to get insurance in Florida after this.
There's no doubt. I mean, we've talked about insurance in Florida for some time. We had a lot of people, as Jerry was saying, move from the East Coast down south and then really get walloped with the insurance costs. And it doesn't seem to be dissipating, Francis, not only for home costs, and of course flood insurance is impossible to get, auto insurance. What do you tell investors now?
Well, you know, at this time, I don't see a lot of market volatility, but I would definitely watch these sectors. I think that the global macro stage is going to have more of an impact in the near future on the overall market scene, what the Fed is doing, whether or not we have a reacceleration of inflation coming potentially in the first quarter of 25. You've got oil up 13.5% in the last month, though it's down today. You've got the CRB commodities index up 8%. So, you know, you have these rising internal prices that have a lag effect going into headline inflation. And so if that hits 3 again, how that's going to affect interest rates, what this does to the employment picture, how do the hurricanes change the job numbers? How many job losses are there? How many business closures are there? What kind of, you know, how does it affect the job numbers? How does the Fed absorb that, you know, as they change policy? Globally, we are going, you know, we have an easing that's going on globally. So you're seeing sort of a resurgence in the global growth and the industrials and things like that. But we'll just have to see how sustainable that is and then how much the hurricane affects the data going forward.
Yeah. And Jerry, quickly, Generac, that was another name that you're watching. Do you like that one? Would you buy it?
Yeah, I mean, I think she made a lot of good points. I think you look at everything that's happened with the hurricanes and all those trickle throughs to the economy for opportunities to do things. We saw Generac hit a 52-week high. We've owned the name for a long time. We thought it was an opportunity to sell calls. So we looked out to January, sold some of the 210 calls for 2% of premium. We thought that was a relatively easy trade, just taking advantage of the volatility in the markets.
Wonderful to see you both. Jerry Sneed, Procyon Partners, Francis News, and Stacy, Global Digital Finance Committee. Thank you both for being here. And thank you, friends, for being with me here on the watch list. I'm Nicole Petalides, every day at 11 a.m. and 2 p.m. live at the New York Stock Exchange, Schwab Network. You can get the app in the Apple App Store, schwabnetwork.com.
This election season, stay out of the muck and the mudslinging with Schwab Network's by-the-numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk. No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
The market is a multi-trillion-dollar beast. When there's profit there, you take it. That's always going through my head.
My job as a trader is to just make money.
With a history and a geography degree, how did you find your way into trading?
Trading attracts a lot of the best and brightest students because it is this enormous data set. It is incredibly competitive. And so if you really want to put yourself out there and test yourself and find out how good you are, it is very attractive.
So how are you exploiting human weaknesses?
Being lucky in trading is great, but it's not the formula for success.
You need to be able to find opportunities in the marketplace and sift through enormous, staggering amounts of data.
You certainly see patterns. Context is so important.
I think the best traders I've seen have insatiable intellectual curiosity. Otherwise, certain parts of your skills will become outmoded by competition or by technology.
When we look at your whole brain, we don't see any activation in these emotional or reward pathways, as if you don't have an emotional reaction.
I'm not very good at sales, turns out. I'm very good at trading.
I have a trading system that I've used for over 10 years now, and it's almost second nature to me.
Do you think that this is potentially a human superpower?
Welcome to Market Overtime on the Schwab Network.
Quality focus has worked pretty much across all 11 sectors.
We deployed a fantastic array of new technology.
The companies that are doing well are almost too big to fail.
Have you set yourself up correctly?
It's controversial. The old guard is saying, away, off with their heads.
AI feels controversial and it's going crazy right now.
It is going crazy.
So what does all of this mean for the market?
As long as people want to buy it, the price can go up.
Oh my goodness, the Fed cannot do everything they used to do to save this market.
Instead of taking cues, set the cues.
There's nowhere else I would want my money.
No more than 5% in any one stock, no more than 20% in any one sector.
Now there's a market for every single one of these people. There's a market for you.
Market Overtime on the Schwab Network. Thanks for tuning in. Good afternoon and welcome to Market on Close. I'm Oliver Rennick. Thanks for tuning in. We got an hour into the day here and stocks are in pretty good shape. A nice ramp to kick off this morning. It's now broadened out a bit. You've got all four indexes up after it was pretty much a NASDAQ show at the opening bell. Going into the closing bell.
We could drop more.
Show. Bull market raging on and healthy and looking good. S&P's up 47 points. Big tech doing a lot of the work. That's welcome. Leadership, very much welcome from the AI, from the semiconductor trade today. NVIDIA's up pretty big, about 3%. Taiwan Semi also jamming. You got growth stocks out front. High beta trades doing very well. Overall, pretty much everything working. Even the anti-beta trades, when you've got high beta and anti-beta, that's the definition of basically an everything rally. Energy stocks, the only thing down right now is crude oil continues to struggle into the mid-70s. Kind of a nice little bonus, though, for bulls, given that disinflation has been part of the core story. Last week, CPI beat in terms of it coming a little bit warm, being taken in stride by markets, so that's very encouraging. Bonds continue to sell off in futures markets as Treasury yields continue to push higher. Equities are all right with that. A few of the key cornerstones of this high, this record that we put in last week, are holding, and that's very encouraging. Russell 2000. Not too far behind today. Also good to see small caps in the mix, up about 0.5%. The risk on was pretty evident in overnight action with crypto markets rallying, extending recent strength after a dip last week below 60. Bitcoin bouncing back. Now watching to see if it can get out of this long-term downtrend that it's been stuck in. That certainly would suggest another leg before risk-taking appetite of Bitcoin joins in after being behind stocks for so long. Ethereum too, which has effectively been dead money, or maybe dead fake money, is rallying today in a pretty big way as well. So crypto markets are warming up here, and Bitcoin leading the way from early on in the session. Pretty much told us it was going to be a risk-on day. Now we see if crypto can find a new fresh breakout in trend. That's where it's been distinctly lagging the stock market. Downtrend in Bitcoin going back to March. Obviously, as stocks have been trending higher. So if they break out, the coiners, then you've got, I think, a pretty clear message of risk-taking appetite and a little frothing up of the rally, perhaps, beyond just the high-quality tech stuff. That's kind of the message, too, of the Russell 2000 and the general breadth of the market today. Lower quality trades also doing quite well. Market here finding perhaps some confidence around the Fed speak that cuts are still coming, despite some firming of the economic data. Generally, economic data beating expectations over the last 2 weeks have been a welcome development as we see the investing community find some comfort in the economic outlook right now. Kind of looks like the only thing really maybe holding us back looking forward is the election and how that's going to go, and perhaps, hopefully, doesn't linger until January. But if VIX at 20 tells us anything, it might be that volatility still kind of lingers around that big event for the year. But generally overshadowing that is strength in the core trades that matter the most for the market. NVIDIA is about to make another closing all-time high. Haven't gotten quite through the intraday highs on the candle, but don't think we need to get too picky here. Taiwan Semi also breaking out. Not as big of a percent move on the year, but still a very impressive one, of course. The two real leaders of this AI trade continue to hold their leadership. TSM up 90%, NVIDIA up 190% this year. Advanced Micro Devices down again today. Chip makers overall are up 1.8%. Enough
Apple
working
double top
in the middle
end.
of NVIDIA to keep that trade reliable and out front. And that is such an important part of this market still. Can't be underestimated. As we begin earnings, obviously tech is going to play a very important role, but so far the numbers that we're getting from banks are also doing a good job keeping the market afloat. Financials hanging in there again today. A little bit of chop from some of the big leadership last week, but as we get into earnings season, that's really the main catalyst here. There's not a lot on the economic calendar this week. We'll get retail sales later on in the week. That's about it. We'll talk about some of the Fed language that's percolating after minutes last week. Showed a little bit of dissension, but generally 10-year yield of 4.1% continues to move higher. We're moving through 4 with some fair amount of ease. Bonds selling, definitely pretty consistent right now, but market is okay with that. To see yields up, stocks up together, gotta love that. That's gotta make you feel good. And then crude oil, again, kind of that cherry on top, because as long as WTI can't stage any sort of a rally, then you don't have to be worried about reflation that much, I wouldn't think. I do still suspect that China's uncertainty is playing a role in keeping a lid on crude oil. See FXI after the big rally a couple weeks ago. Stay under some pressure. Kind of similar in that crude and FXI had the peak on the same day earlier this month. So as long as the U.S. story remains solid here, that's good. The rest of the world still looks like it's lagging behind us. Crude oil not catching quite enough demand. OPEC also revised some of those growth expectations for oil demand downward. So I do think that's connected to the rest of the world. Not really an issue for us. And it also helps the inflation discussion as the markets are finding pretty much a Goldilocks environment coming back. So looks like a pretty good day here. Stock market's rallying and continuing to find new highs by the session. Every session, new record. Let's go to New York. Markets correspondent joining me here in the afternoon, Caroline Woods. Morning duty, afternoon duty. Great to see you, Caroline. What's up?
Hey there, Oliver. Well, you basically hit on everything in terms of the market action, in terms of what's working. There are a few things not working that you didn't necessarily mention. Boeing, of course, we're kind of used to that being the odd man out of the rally. Caterpillar, of course, was downgraded by Morgan Stanley, turning all out bearish. So shares of Caterpillar under pressure. Netflix actually under a bit of pressure today as well. That's obviously an earnings highlight this week, and expectations are high given how far it's already run and given the impressive growth it's already seen. But overall, the AI watch list that I have certainly, for the most part, higher, aside from Intel, AMD, and Supermicro. And then energy, of course, the only sector that's not participating in the rally today. So, yeah, definitely a good day. Earnings season really picks up steam tomorrow with the big banks and then some of the regionals. And then I mentioned Netflix. Of course, we'll also hear from United Airlines, Procter & Gamble, J&J. So there could be reason to not continue this rally, but right now it all seems to be working, and we're kicking off the week in record-setting territory here.
Yeah, absolutely. Good to keep us honest, finding a few of the laggards. As you mentioned, kind of Boeing, that's just sort of how it is. Seems like, at least the market is able to make some choices, discerning perhaps in its stock picking ability, but, right now it's kind of just pan Boeing, a few others, CrowdStrike too, kind of stuck. The stuff that matters is working for us. Yeah, go ahead.
And to your point too, in terms of what's not working, we talked about this earlier this morning too. Some of the retailers got downgraded over at Wells Fargo, so we see Canada Goose, Amer Sports, and VF Corp under pressure. And to your point, that we'll get retail sales later this week. We'll also get earnings from companies like Discover Financial and American Express, which aren't necessarily economic data, but should shed more light in terms of the strength of the consumer, what they're spending, their credit patterns. So I always look forward to those, especially given how solid the consumer's been, but how we've been getting mixed signals for quite some time.
Yeah, it's going to be interesting if Discover breaks out, makes highs, because it's looking like it's about to, given that folks were it's kind of signaling concern about the consumer earlier this year. We just keep threading the needle, it seems like. Rolling our debt, keeping our job, paying enough off of it to keep on spending. So that note from the Wells team on the retail stuff does seem to have a little bit of an impact today, but we'll see what happens on retail sales. I mean, how bad could it be if, some of the language we heard from the banks last week too is that credit has deteriorated somewhat, but not in an alarming fashion at all. It seemed like the message was that they're pretty confident about credit, generally speaking.
And maybe that's why Starbucks, according to the Wall Street Journal, is actually rolling back some of those discounts that they've been offering to try to get more people back into the stores. You actually can see Starbucks shares under pressure today, and that's one of Brian Nichols' early moves, according to the Journal. They're going to be getting rid of, or they slowly are getting rid of, the discounts, which is interesting because they had to implement those discounts to bring more people into the stores because they've been under pressure based on inflationary pressure and also just how expensive things have been. But they want to get back to being a premium brand and focused on handcrafted expensive coffee. And maybe all this commentary from the banks leaves them confident that consumers can spend even if there aren't discounts or extra points offered.
Yeah, fair enough. All right, noted. The other thing, too, is that the Fed commentary seems to be pretty cool, pretty collected, pretty calm. You know, nothing really that's going to throw us out of whack, it seems like, especially on a week with limited economic data. Maybe the market doesn't expect as deep a cuts as it did a week and a half ago, but then you got folks like Kashkari out saying, look, it's, some form of a cut is coming again.
Yeah, he was speaking in Buenos Aires earlier today at a conference and basically said, as of right now, it appears that further modest reductions in our policy rate will be appropriate in the coming quarters to achieve both sides of our mandate. So basically in line with what he's previously said. He added, ultimately, the path ahead for policy will be driven by the actual economic inflation and labor market data, aka the Fed is data dependent, which we've been hearing. There's of course been a lot of back and forth about how much more the Fed will cut, especially given that slightly higher than expected inflation data, hotter than expected inflation data that we saw last week, and then given the better than expected jobs report, it seems like 50 is off the table. But Jay Powell actually said basically that 225 basis point cuts are expected for the rest of the year. Neil Kashkari said the most recent jobs report is encouraging, that a rapid labor weakening does not appear to be imminent, and inflation has come down dramatically from its peak, but remains somewhat above target. The Fed is in the final stages of bringing inflation down to its 2% target. So he said that the current policy stance is restrictive, but in terms of the extent to which it's restrictive, he said, is unclear. But it's very much in line with what I think we were already kind of expecting. So not necessarily adding fuel to the rally, but not necessarily taking away from it either, because this is a market that expects at this point the Fed, more modest rate cuts moving forward. Okay.
It does seem like the real kind of trigger language for bulls that they love to hear is the final stage of the battle against inflation. That kind of language certainly makes us feel good and does kind of match the tone from Jerome Powell and others that was fairly victorious around that 50 basis point cut. So maybe we don't get another 50, but 25s into the future seem like we can count on that.
I don't know. I think expectations change so dramatically, so often that it's hard to say, because we have to wait. We have to get through the election first, and then what is it, November 7th that the Fed, I believe it's November 7th, the next Fed rate decision. So we have almost a month, and I don't know. If I've learned anything, it's that it can certainly change on a dime.
That's true. The market generally has gotten it more wrong than right the last year and a half. So. Okay, but Kashkari sounding a little bit more kind of dovish again after being a hawk for a while there. Thanks, Caroline. Good analysis and a good look at some of the stuff in the market here today. Outside of the big tech winners, let's get another take on the market, the economy, and also the private markets. The co-CEO of publicly traded Hamilton Lane, Eric Hirsch, back with us here on the show. Eric, thanks for being here this afternoon.
Oliver, thanks for having me back.
And so your guys' stock's done amazing. So let's kind of start from the perspective of what's happening in your world. And I mean, shares on the year up 60%. So as we're having a conversation here about financial institutions, risk appetite coming back into markets, kind of seems like Goldilocks. I mean, is that playing a role in your guys' success, or are you pushing competitors around in the private market?
I think the big driver is that we're really seeing kind of a sea change here where, up until basically the last few years, the kind of average retail investor has not been able to access the private markets. And so that is changing. And so we're seeing a whole new entrant into this asset class, benefiting from what the institutional investors have been benefiting from for decades. And we've been launching a variety of products in that space. We've been doing quite well. And I think that for us sort of sets us up for sort of ongoing growth for a long time to come.
Thinking about how the private market will interact with the public one when you get this type of moment where markets are breaking back out We see generally rates markets calming. A lot of folks look to the public markets. They go, okay, we're going to get a bunch of IPOs. We're going to get debuts. Do you see that happening? Do you see any transition from private to public, or private markets functioning smoothly enough these companies don't need to go and tap?
I think there's both. So I think we're absolutely starting to see some IPOs open up. That window's getting a little bit more open. Again, high quality businesses with good growth and profitability. But the public markets have a challenge. They need more product. Because to your second point, Oliver, the ability for companies to remain private for long, if not forever, is very much present. And so what had typically kind of driven businesses into the public market is just no longer reality. You can access plenty of capital, unlimited capital, whether you want equity capital or credit capital. You can do that all in the private markets. So if you don't want to be public, and if you don't have a good reason to be public, and as you know, being public is not without its challenges. For us at Hamilton Lane, the reason to do it was really around continuing to build and scale our brand and becoming a better known financial institution. And so we're getting that benefit, and we're willing to sort of deal with some of the pains that come from being a public company. But if you don't have a defined benefit, the private markets are going to allow you to stay private for as long as you want.
What kind of momentum do you see in deal making in private markets? Is there then an argument for companies that have taken some lumps in an interest rate hiking cycle to maybe go private? We've definitely certainly seen a good bit of M&A start to warm back up again. What about through that lens, Eric?
I think we're going to see all of that. I do think we're going to see more of this sort of generally pick up sort of post-election. I think as we sit here, we're basically, as of tomorrow, 3 weeks away from Election Day. And so I think until we sort of see that settling of that decision, I think you're going to continue to see people a little bit hesitant to say, today is the day. Right now, just wait 3 weeks. You at least have a much better picture of sort of where the country is going and what kind of policies we can expect, and then what the flow through of that to the economy is going to be.
Fair enough. What are going to be sort of those characteristics or the things that you look for deals post-election? Is it concentrated in the areas where there's a lot of growth, or will the deal making be the stuff that's kind of in the fallout more from AI's takeover? Companies are going to have to regroup and maybe retool.
I think for us at Hamilton Lane, there's a couple of just key areas that we're spending a lot of time looking at, and they're both kind of wind at your back kind of plays. One is healthcare in the United States. We're an aging population, the desire and need for better healthcare, in many cases higher end healthcare, as you have a lot of increasingly wealthy retirees that are going to want more in-home services. I think that is an interesting play today. And then there's just a huge amount of need for infrastructure. When you sort of joke, just go drive 10 minutes in any direction and you're going to find a bridge that needs something, a road that needs something. And I get that the comeback is, well, isn't the government going to take care of all of that? And our response is, well, the government hasn't taken care of all that to date. And despite some of the stimulus that's going into that space, there is still a lot more needed. And I think you're going to see a side, but some of this is just going to be flat out financed by the private side. From an investment standpoint, if you're an investee, what a great place to have some of your retirement assets in an infrastructure space where you can either clip some coupons, have a long, low volatility, longer duration with good capital appreciation. So I think the combo of those factors makes that a pretty interesting space.
It seems like infrastructure is a core theme in two of the funds that you guys recently made available to high net worth investors. I want to come back to that, as you mentioned at the top of our conversation, important for those watching that are looking to branch out their exposure to different types of investments. Are these funds considered like alternatives, or how do you envision them fitting into the everyday folks' portfolio?
So if you look at the institutional investor, to date, they basically have about 15% or so of their total assets, their pension, if you will, in the private markets. And if you look at the typical retail investor, their exposure to the private markets on average is about 0%. And so as we sort of think about the benefits of the institutional investor and why they've generally outperformed the average retail investor, it really has been the inclusion of the private markets. And so what makes that up? Well, the core of that is private equity. And then you start to add other strategies like venture and growth equity, real estate, infrastructure, and credit. And so for Hamilton Lane, We're trying to just make a series of products available to the retail investor so that they can start to access this asset class in a similar way that the institutional investor has long had access to. Infrastructure, we think, is going to be an important part of that. It's a space that I think people generally understand. Bridges and toll roads and building data centers, all of that is stuff that most of us interact with in some way, shape, or form every day. And so being able to invest some capital in that space and benefit from that, we think that's a real advantage.
We had last week conversation, one of our guests, Sadek Waba, who just wrote a great book on infrastructure called Build. Leader of I Squared Capital was making the case for public-private partnerships. I'm curious your thoughts on that and whether or not they have potential for a bigger role, maybe going forward. I don't know. You don't really hear any of the candidates talk about that type of stuff in that detail, but I do wonder if that's something that can be part of a brighter horizon here for how we get these projects done.
We should be talking about it. I wish the candidates were talking about it because, again, I think infrastructure is kind of both offensive and defensive. From a defensive perspective, again, we just need our infrastructure, the power grid, roads, rails, airports, et cetera, to just simply work in order for this economy to keep moving and in order for the citizenry to sort of live a better, safer life. On the offensive side, what's happening in AI, obviously in the public markets, easy to access sort of all of the chip players and sort of play that theme that way. But if you think about sort of the bricks and mortars of that, huge needs in power. If you're going to power those data centers, again, where is that capital coming from? That's going to be private investments for the most part. The data center itself, again, that is a sort of build it, then long-term recurring locked-in revenue from that sort of service provider. That's an interesting space. Again, that's going to largely come from the private sector. So I think you can look at infrastructure through two different lenses of what problem you're solving for. Are you looking more for the offensive growth opportunity in that, or are you looking for more of the defensive play? But I think there's opportunity in both areas.
Love it. All right, good stuff. Eric, thanks a lot for the conversation. Be in touch.
Always a pleasure. Thank you.
Appreciate that. Good perspective, good look. Eric Hirsch, co-CEO at Hamilton Lane, HLNE is the ticker. Also the two funds that they launched, HLGPI, the Global Private Infrastructure Fund, and the Private Infrastructure Fund, HLPIF. Let's talk some healthcare when we come back. Gonna look at the 3-year anniversary of a really interesting healthcare fund and the role that some of the weight loss drugs are playing and big healthcare topics, not just the aesthetic ones. We'll be right back.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Knock, knock. #1 broker here for the #1 hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to Market on Close. Let's dive into healthcare and talk the returns. Simplify Healthcare ETF Pink, since it debuted 3 years ago in the middle of Breast Cancer Awareness Month. It shares up about 25%, beating the healthcare sector overall. The portfolio manager joins us to talk about the sector and the strategy. Michael Taylor with us this afternoon. Mike, thanks for being on the show.
Hey, thank you so much for having me on.
You guys are in the 3-year anniversary of launching this fund. Tell us.
Fees associated with Pink and my company, Susan G. Komen Foundation for Breast Cancer.
And on top of that, you guys beat the market. The S&P 500 health sector is up about 17%. Fund performance is up 25%. So that's a pretty good margin there that you're ahead. Where does that come from? What are the big winners in here?
We call it alpha. And some of the big winners, it's actually a diversity of many, many names that outperformed. It's never a one-name approach to this fund. It's many. And a lot of that comes from my hedge fund background, which I've done for the past 20 years.
The weight loss trade, Eli Lilly's played a pretty big role in that, right?
It has. Lilly in the GLP-1 space has been a huge performer, and for good reason. It's an exceptionally huge market that is very likely going to grow significantly over the next 5 years.
Right now, when you look at the competition, is there enough to go around? So much demand. It seems like there is, a good amount of demand to sustain multiple players in here. But you've got Eli Lilly in there at the top, so you're definitely omitting a few other participants from the top 5. Why Eli Lilly to represent that whole theme?
Well, it's in the top. Really, I deal with it quarter to quarter and what's going to work, in my view, and what's not going to work. And I think Lilly has some new indications that are coming on that are going to be very significant and drive revisions up. But in order how we outperformed in this regard, it's really a pan stock selection. It's never just one. And our names tend to change a lot. It's a very actively traded fund, and I'm one of the largest shareholders. So I treat this money as if it's my money.
Got it. When you look at the activity, how active is it? How often are you rebalancing, or is it pure alpha? You can do what you want when you want.
I can do what I want when I want, and we do a great teamwork job here at Pink. We have a lot of eyeballs on it, a lot of risk management, and a lot of thought that goes into portfolio selection.
Pure Cycle's a pretty interesting one. It's like a medical devices business, which is second in the fund right now. Tell me about that, as that's a pretty big holding in there, right up there with Eli, like 7%.
It is very rare that we have such a large position in a smaller cap name. PCT is actually a chemistry play. They have devised the first and only mechanism to recycle polypropylene at economies of scale. And they've launched their first plant, and we're looking forward to seeing some serious production and revenues next year. It's a 200 billion pound market for polypropylene, and this is the only player. So they're going to have pricing power, white space, no competition, and an incredible market to grow into. Nobody knows about this stock yet.
So why is it so important? And it seems like also, part of the reason it's become a big part of the holdings as a mid or small cap company is it's had this big rally. So do you hold on to that, or do you have to trim down based on how much it's moved, or is this going to remain as a big player in the strategy?
Well, the market for PCT is so gigantic and so long-lasting, it looks like the duration is gigantic. I even think it's equally as large in Europe, if not much larger than the US, because they have a lot of promotion for using recycled plastic. So you put that all together where they're at right now, and we're not there for a 2x or a 5x or a 10x return in this name. We're looking for much, much more.
Wow. All right. So you think this is a zoomer coming in the long term? United Health is in there too. I think like number 3 right now, which just broke out to a 1-year high today. Give me the case for owning some of the insurers at this point.
Well, what's going on with the insurers is a real selective group here. UNH is by far the outperformer business-wise, and I believe that's going to stay that way into next year. Many of its other competitors are going to have great difficulty next year. So our sizing is really more about weightings in the group, where I don't actually love the group overall, but this is the one that I like most.
All right. I love the details. UNH, PCT, Lilly in the top three, and of course, love the purpose of the fund with the fees going back to the cost. Thanks for your time, Mike.
Thank you so much for having me.
Absolutely. Michael Taylor, Portfolio Manager, Simplify Healthcare ETF, PINK. Pink is the ticker, the 3-year anniversary of 25%. Let's look at options flows next. Going into the bell, 30 minutes left. This morning's rip was in the NASDAQ, and then it spread out to the rest of the market, so we're in really good shape right now with a 50-point rally roughly in S&Ps. Kevin Green with the check-in next.
What we got here?
Trading at Schwab is powered by Ameritrade, bringing you futures and Forex for round-the-clock market access, even when equities markets are closed. All on our award-winning Thinkorswim platforms. So no matter what or when you want to trade, Schwab has cutting-edge tools, curated education and insights, and trading specialists ready to help, however complex the strategy. With a wider range of opportunities, you can trade brilliantly with Schwab.
This election season, stay out of the muck and the mudslinging with Schwab Network's by-the-numbers coverage of the presidential cycle.
How could this election impact your financial future?
Next week is going to be a crazy political week.
Election trades are fraught with risk.
No agenda, no hysteria, just good old-fashioned analysis of what policy means for your portfolio.
Stay informed, stay ahead. Tune in to our election coverage on Schwab Network.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes, 40 customizable themes, up to 25 stocks in just a few clicks.
Well.
S&P 500 nearing a 50-point rally on the day. Kevin Green joins us, our senior markets correspondent, looking at the flows and levels that we should be
Feel like
watching.
something good gonna come, but just not today so far.
Oh yeah, definitely. I mean, you continue to see a lot of aggressive call buying activity taking place in today's expiration, Oliver, and you're not really seeing a lot of fades right now. And when you're kind of looking at it across the curve, especially with those institutional flows that we really
He just
follow,
said it.
you're continuing to see rolling up and rolling out activity taking place, especially for the year end, the December 31st options. Kind of looking at 5,900 was getting hit today, and I also saw a 6,000 print going there as well. So this is kind of alleviating some of this upward pressure that we have seen when we're looking at these gamma levels. Now for today, if you're kind of looking at it for the close, there have been some traders looking at the 5870s. Maybe that could be a little bit of an area that we do try to test going into the close here. And if not, potentially maybe a little bit of a phase of a downside. But it's going to be very hard because if you're looking at the advanced declining line for today's chart, you're actually continuing to see that rise to the upside. I mean, we have over 80% of these stocks in the S&P 500 participating. And once again, when you're looking at call versus put flow, I mean, the calls are definitely handing it to a lot of the bears in the market. No one's really selling at this point. I'm not sure if that's a good sign or a bad sign for the next couple of days, but it looks like complacency is definitely in the market. And when you're looking at the VIX, we did see it break that 20 level. It's still elevated on a relative basis, but we are starting to see it kind of grind lower here. If we can get to that 18.5 or even that 17 level by the end of this week, I think you're still going to see a lot of risk-on activity in the marketplace right now.
Okay. Yeah, it seemed like VIX finally responding a little bit more here today. To come back to your chart real quick, it's kind of got this like ascending sort of wedge in a way, which is bullish as long as it doesn't break. Not the advanced decline, the other one real quick if we go back to it just for a sec, because I thought that's kind of an interesting pattern. I mean, does that need to hold up, KG? Does the ascending wedge, how does that rank among the bullish patterns?
Oh yeah, it's definitely bullish, and actually we broke out of it. So if you're looking at the open interest chart, looking at the 3-month daily time frame here, I mean, we actually did break out of it today, and this is one of the areas of concern that I had. We've been trading and utilizing that upper end of that channel line as an area of resistance. That's not the case now. So we want to continue to see follow through over the next couple of trading sessions, and then coming back down, retesting it, and then moving higher would be a bullish signal to say the least. But yeah, this is actually, today is a breakout day for this pattern that's been setting up for the last 2.5 months, Oliver. So this is a huge win. I know you talked about the anniversary for the bull market here, and this is kind of that capstone of that for now. Once again, when you're looking at the downward areas of support here, 5,800 is going to be the key area to be able to hold. We're kind of getting farther and farther away from that, which is good. And then 5,745 is going to be that negative area over the longer term that could actually create a little bit of a downward spiral with the market. But this ascending channel that you are seeing right now has officially been broken, and this is once again another feather in the cap for the bulls.
All right. Yeah, the breakout, kind of within the breakout, is a good way to look at it. Kind of fun little cherry on top of the 2-year anniversary, to your point, because we kind of had the price breakout from the range in the 57s that we were stuck in, but now with your context of the ascending wedge there, it's a nice additional breakout. So
it's interesting.
Way you're looking at it, you're getting fresh momentum to the upside. Now for the advanced decline, that seems to be good too, because generally you like to see breadth.
Oh.
But I prefer
There's the breakout.
leading, and that kind of seems like exactly what we're getting. We're like getting breadth, but we're also getting the important stuff out front too.
Yeah, I mean, I'd rather just see as many stocks as possible really participating. I could care less what sector they're a part of, but yes, tech is going to be that risk on indicator here. Now, actually, if you're looking at today's chart, we had that initial move and spike to the upside when we started the morning, really testing that 5850 area, which was
very nice
area of resistance for today. And we actually had the advanced declining line actually move to the downside, but then we started seeing us kind of powering up. We had this flag pattern, this bull flag pattern taking place. We broke above that 5850, kind of consolidated at 5860. That's your next area of resistance, if you will. But as we were kind of hitting those levels, we started seeing a lot more participation from stocks, and it's hard to really try to knock the market down if you have more participants taking place to the upside here. Now, we could have a reversal of this, right? We could have mega cap tech maybe selling off into the close. I'm not saying that that's going to be a likely scenario here, but even if you have maybe one stock like an Nvidia or a Microsoft or an Apple really selling off, if you have this breadth that's actually continuing to advance, it's going to offset some of that downward pressure here. Once again, this seems like a market that really continues to want to push higher here. We actually did just touch that 5866 area, so getting close to that 5870. Let's see if we're going to be able to touch that, hold it, maybe even go through, and we don't see an unwinding of these calls that have been purchased for the day, which could give us some downward pressure.
Okay. So it seems like all signs are pointing go right now, and it seems like also we're kind of leaving behind a lot of ranges, a lot of levels, and now I guess it's a question of if we melt up, things get really vertical or not. Maybe that's where we look to the VIX, back to your point on how much that collapses.
But it's hard for the VIX right now because we have that geopolitical risk, which I would say it's a small premium there for Israel, Lebanon, and Iran. But it's the election. So it's really hard to kind of back out to say what would be the normalized VIX right now if we did not have the election. It's just hard to say. So that's why I kind of go back to saying, look, if we have an 18 VIX or even a 17.5 VIX, I would consider that to be a massive win for the bulls. That's actually going to kind of re-normalize the VIX curve as a whole. We still have that fall off in the November contract a little bit, and then the December contract is where we have that Santa Claus rally or that year-end rally really being priced in. So even though the VIX is elevated, we always have to just kind of discount the fact there is stuff that's on the calendar that may create vol or may exacerbate vol for all that matter. But I would say we're holding up really, really well in the near term here. And actually, this is the last thing I'll leave you with. A high VIX, if you look at a VIX between 16 and let's say a 20, Oliver, that's actually really good for intraday traders or even swing traders out there. It gives you opportunities for pretty much everybody, bulls, bears, on an intraday basis. You really don't want to see a 14 VIX. Those are boring markets. That's when you have compressed 20-point range markets. No one really likes that. You want to see either trend markets like we're seeing today, or maybe even down markets when we flush in the morning and then come back. That's where the 16 to 18 VIX really gives you that type of environment for traders to really capitalize on.
Key word there, traders. If you're long ETFs and you're just parked, you're probably loving a 14 VIX. Thanks, KG. Appreciate you. Good luck. Great stuff. When we come back, we're going to take a look outside the equity markets, do a little crypto chat, check out the US dollar. Rates also moving higher. Scott Bauer joins us for a check-in on some of the bigger action of the day. Bitcoin pushing 66 now.
Ethan, how's my favorite client?
Great. I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech.
Trends? All that research sounds exhausting.
Nope. Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes. 40 customizable themes, up to 25 stocks in just a few clicks.
Welcome back to Market on Close. Let's talk some movements outside stocks with a big rip in crypto market. Scott Bauer joins us, CEO of Prosper Trading Academy. Scott, good afternoon. Bitcoin was kind of the tell last night. This morning we were going to get a risk-on day here, and now we're back above 65. So is this an impressive move to you? What do you think?
It's a big short covering move here, and there's a few things out there for the reason of it. Number one, you've got the continuation of Mt. Gox, right? That was that defunct platform from a while ago that held over $9 billion in crypto. It's specifically in Bitcoin that was supposed to go back to the holders that thought they lost that. Well, about 2/3 of that did. The other third they just announced is being postponed until next October. So that has taken some pressure off of the market that there was going to have to be maybe some liquidations if that other $3 billion worth of tokens was then, flooded out into the marketplace here. So that has really helped this move up here, and it is just a massive, massive shakeout of short positions.
Yeah, I think that's a good point. And so we've gotten this trend that's held. If that breaks, then maybe we have a little bit of a different discussion. It seems like things kind of within the down channel could be positioning related. Where do you start to think about a new upcycle or a new trend, Scott? Where's the the entry point if this thing really is going to get out of this now basically 7-month channel to the downside?
So I've got two levels I'm really keeping my eyes on. The first one to the upside is 68,000. That's going to be huge resistance. But if we retreat back at all, Oliver, to about the 64,500 level, that's where there had been major, major resistance that Bitcoin shot through. If it retreats back and it can then hold there, and I'm not just saying hold for an hour, but really put in some nice volume around that level, I would probably look to get long it there. And I have not said for a very long time that I wanted to get long Bitcoin.
Yeah, true. Then how do you think about kind of the holding period then, Scott? What's possible in terms of price action? I know that, when you start making highs, which, we basically have to reserve till 74, 75,000.
Yep.
But if we start to get there, gonna hear all the projections come in, what would be reasonable, what's unreasonable to you?
Well, I think Michael Saylor said today $1 million in 2025, right? So
There you go.
that is definitely unreasonable. If we do get back to those old highs, 72.5, 74 or so, when you look at charts and everything, since there's rarefied air above that, there's no resistance. You kind of extrapolate things out, and you look at 80,000 really is the next level. Now, I'm not putting a lot of stock in that quite yet here. I am not in the complete bullish camp at all. My narrative hasn't changed, but from a technical standpoint, if we do retreat back and we can see, some nice support back at 64.5, I'm in.
How about Ethereum? Such a
Shut
different
that off, kid.
situation. Maybe more so than ever, just disconnected chart-wise.